Welcome to today's video episode with your boy Victor Bell in the Bell Zone, or the Victor Bell Zone, where I go over everything from real estate investing, money, finance, and all of that, because I love it, money, all of it, because I think it's important. It's something that I wanted to share with you guys today specifically, and it's kind of what I call my wealth multiplier. Like, you guys have seen this, especially if you watch anybody who now is going over multifamily investing and how it works and how to multiply, how to turn, like a dollar into $40, whatever. But when I started doing this, when I did this, I didn't know, no one was teaching it. It just kind of came, like, actually someone showed me. They're like, hey, Vic, here is the plan that we use on all of our multifamily deals. It was my buddy Ken. Ken had a bunch of multifamily deals, and I was working my way into that world. Now, bear in mind, at the time, it was Hawaii real estate, and that's when the cap rates were 4 and 3 and 5, and you get a bunch of investors out there going, how are they making money? None of these deals pencil. So they look somewhere else. They look at like lower price markets, like people in California and stuff like that. Like people who couldn't get in. So, but this is so simple. I've used this 100% probably over the last 10, 11 years now, looking at every deal. So to me, it's not new. It's just now everyone else is saying it, and I hadn't been saying it because very few people share this information. So big thing, I'll do this. Wealth multiplier. Like, so I'll give you the formula first, and then I'll go over a very specific deal that I did, and then I'll share with you how it walked. All right. So basically all it is you take the rents times 12 months, right? Gives you a number, whatever that is, like the gross potential rent, or the rents, right? And then you just basically divide that by your cap rate. Right now we use 5. You can use 6. You can use 5.5. You can use 4. Like, there's still deals that I look at in 4, because we are in California, San Diego, and deals are still trading at 4.5 caps. There's no one wants to buy them like that because of the way the debt is, but that's what it is. But for this purpose, I just want you to understand what that multiplier is. All right. So, for example, I give you one of our deals. So we bought a deal for $1 million. It was a multifamily. We actually bought 2 deals, and it was a package. But we bought 2 deals. And with those deals, the rents were roughly about $1,000 when we bought them. $1,000 a month, right? That was the rents where they were. So my buddy was like, "Hey, Vic, here's what you're gonna do. You're gonna figure out how to get the rent, how to bump the rents to 1,300. Boom, that was it. From $1,000 to 1,300. They were low already. Now, here's the deal. Let's say they weren't low. Let's say this was market rent. Now, I kept this deal for like 7 or 8 years. We refinanced it. I'll share with you. I'll share the multiplier situation that after. But it was really because we're able to get the rents this dollar figure. So all you're going to do in this situation, and we'll use one property. One was a 10-unit building. So this is a proof of concept, right? Let's show you where this is. So it was an additional 300 times 10 units, brings you to 3,000. This is a small deal, right? Times 12 months, it's $36,000 divided by 0.05, $720,000 increase in value of the property, right? So not only did we increase the income, the revenue of the property by $36,000 a year, we also increased the actual value of that property by $720,000. That's it. So sometimes when you see these big guys that have these big complicated metrics, whenever I look at a deal, that's all I'm trying to figure out. And be honest with you, the way that I look at a deal, because I'm holding long term. Now, we did way more than a $300 rent bump over time, right? But that's a small deal. The deal that we're looking at, if I can get $600 in a rent bump over 7 to 10 year hold, that's a winner to me. So, for example, like we looked at a deal the other day. It was 178 units. And let's say, for example, hypothetically, because the rents in that property right now are $2,700 a month. So even right now, $2,700 a month, great location, plus 600. Do I think that at that location in the next 10 years that property's rents on the average are going to be $3,300 a month? Absolutely. That property is in a great location, a little bit further down away from not a high school, but a hospital, great high schools in the area. The shopping centers around there. There's a shopping center around there that's a $40 million shopping center, right? Like all the stuff that supports that community, hospital, jobs, great schools, things like that. And it's near the SDSU. So that said, it was 178 units, and we're just using the multiplier. That's it. Just looking like, hey, Vic, do I think, don't go to 3,300. Just deal with where things are now. That's the value of where it is. But if we can go 600 times 178 units, that's an additional $106,000 times 12 months. That's an additional $1.2 million in new revenue that was created in that property on an annual basis. That's it. All right. Divide that by 0.05. By 0.05. That increases that property by $25 million, 25.6. So when you kind of really start to see the power of Wealth X, the wealth multiplier, you start to really see like, hey, how are you start to question, like, if you're an outsider looking in, how are these guys making money? That's how they're making money. Now, let's look at it from this perspective. All right. And if for you people that are questioning, okay, Vic, well, this property is already at $2,700. How do you know the rent's going to continue to go up? Well, first, I'm judging it based on a 7 to 10 year hold. I underwrite for 10 years on a hold property. Like, I'm like, dude, let's say we get this property and we had to hold it for 10 years. Now, and I'm going a little bit deeper on this. I probably shouldn't. Times, let's say, a conservative 3%. That's $81. That's conservative. Every year, we're able to raise rents on $2,700, $80. No one's going to move out for $80. But like I said, if we did that for 10 years, that's $810 a month raised over that 10-year hold period. Like I said, that's not that much. Even if we scale that back, let's say $81 times 7 years, it's still 567. That's really close to the $600 that we're looking for, guys. So like when I say, hey, this is my target. Let's say on a very conservative thing, rents only increased by 3% a year, which you guys have seen what's happened. They've increased by way more than that. Now, some of the stuff that you watch people say, oh yeah, the rents are softer. They're only soft in bad properties. In the good properties, people are still raising the rents. Newer properties, nicer locations. We're not talking about C properties. We're talking about B plus A areas, really great locations. Yes, that location will give a $600 rent bump minimum in over 7 to 10 years on that whole. But like I said, think about what we did though. We went on 178 units. The increase in value just based on this was $25 million. This is how people create wealth. This is how people get rich. This is really the way that it is. Now, that's an increase in value. That has nothing to do with where the value is today. That has everything to do with, like, how are you going to do this? Now, you got to do something for the $600. You can't just bang people's rent. Sometimes you do. Sometimes you can go in and say, hey, we're raising rents, right? $100. Then the next year it'll be another $100, and you do it in 6 years, or maybe it's $200 because that's not impossible to do, especially when the property's kept up. But this, guys, is 100% what I look at. Every time I'm looking at a deal, I'm like, hey, do I think the location in this property is going to give me a rent pull over the next 10 years? Do I think that the rents will be at least $600 higher than where they are today at this specific location? If we buy this property, treat the tenants good, or our management company treats the tenants good, I take care of my investors, we got good bank loan on the property, do I think that we can make $25 million on this deal based on raising the rents? You know, if I can say yes to that, then great. But if I look at it and go, look, there's no way that I think the rents are going to continue to grow at this location. We have this happening, we have that. I don't look at the deal. I'm like, I'm not interested in looking at a deal that I don't think we can get where I can use my wealth multiplier. Right? I've done it every time. It's not a guess. It's a proven concept. We did it with 3 properties over there. Now we're just doing it with bigger properties over here. There's no difference. It doesn't matter whether it's a small property or a big one. That is how you kind of create wealth, or how wealth is created by some of these bigger players. So I hope that helps you guys. That is the formula. Whatever the rent is, times the number of units, times the number of units. Rents times the number of units times 12 months divided by whatever cap rate you're going to use. And if you want to play with it a little bit, you can say, hey, properties in my area are trading for a 6 right now, or the way the debt market's going, people want a 6, but nobody's going to get a 6 in these tier 1 markets like I'm playing in. But underwrite it there, see where you're going to be, right? Even on a worst case scenario, what if when you sold in year 10, you had to exit at an 8. And at an 8 cap, oh, no one would want to do that on a really nice property. But what do you need to do? For us, when I look at this, I'm like, okay, let's look at this property. Let's say we had to hold it for 10 years. Let's say things were not going well, but that doesn't mean rents aren't going up. That just means that maybe the market cap rate has changed, but rents are still climbing. People still need a place to live and rent. I do that same number. Let's try that, guys, just for this purpose, because I enjoy this. You guys got to practice this too, so you understand, if you're going to invest with me, how I underwrite my deals. Aside from underwriting them as is, I'm like, hey, how much is this thing going to be worth to us as an investment, as an asset in the future? And how do we do that? So $1,000 times 178 units, right? It's 178,000 times 12 months. That's $2.1 million in increased revenue, right? Over 12 months, divided by 0.08, we're at a $26.7 million increase in value. Why does that matter? Because now we're running a worst case scenario. Let's say we're like, hey, man, we have to exit this property at 12 years. We kept it for 10. Now we're pushing past and we're like, the market's at 8 because the whatever took a dump, hypothetically. What is the new rent that I need to hit to still achieve my wealth multiplier? Do I think over 10 years, this property, if it's going to hit 600, and I think that's low, over the next 10 years on a whole, I'm pretty sure that same property for, what do we say, 2,700 will now be 33. Do I think that property for 2,700 a month rents could possibly be 3,700 a month, $500 more? If we took care of the people, we took care of the property, same strategy. But that's a worst case scenario. And here's why this is important when you run worst case scenarios, especially with somebody like me, who's actually managing the assets for me and my investors, because I'm buying the deal. I need to know what my job is. I'm like, hey guys, look, yes, this is a target, but we need to also keep this in mind too. Can we ever get to $1,000? How quickly can we get to 600? And then how quickly we needed to get to $1,000? Is that possible? Right? Because once I know what my job is, hey, my job is to start having my management company start raising the rents. Then we can start looking at the numbers and finding out, hey, where are we at on this thing? How are things coming? How quickly are we able to turn over these units on our rent roll, right? And I'm asking the management company these things. So like, hey, could we test the waters? Can we get an extra $1,000? It may not need to be rent. Maybe it's a Butler, the Butler trash, maybe the Valley trash stuff. Maybe it's we pay for parking. Maybe it's different amenities that we can add a little bit, 25 here, 35 there, things like that for people who want a little bit of a higher service at the type of properties we're looking at. It doesn't always need to be through exact rent. It could be through additional income on the gross rental income, on the gross potential rental income side. So on the gross potential income side. Anyways, guys, this is important. The big picture here, what is your wealth multiplier, Victor? Boom. Rents times the number of units times 12 months divided by the cap rate. That's how I know how much money we're going to make on a deal. That's what I do specifically. I look at every deal using that metric. First, I look at what it's doing today. That's what matters to me now. Then I'm like, hey, what is the best case scenario? Can we bump rent $600, $1,000 over the next 7 to 10 years? Yes, good. Okay, now for a different video, what is our price per door broken down for where it is today? Are we in line? Next, what is our break-even occupancy ratio? That says, hey, if we drop down below where this break-even occupancy ratio, where now we're able to pay our debt, we're barely able to pay our investors, do we still want this deal? And let's say our break-even occupancy ratio, which again, I'm getting long into something, but I think it's important, is past where we need to be. Has that property ever broke that number? Has it ever been past there before? COVID, whatever's going on, like has this property ever seen these problems before? And then do we want it? Because if it has, we may not want it, right? If we can't hit the wealth multiplier for myself and my investors, pass. If it's not operating today where I think where it is, it's going to be good and we can get in it, pass. If we can't get past, or if this thing has already been past the break-even occupancy ratio that we ran, and we're looking at this thing and we think it's going to be an issue, and we know we don't want to have that type of a headache, or I don't want to have that type of a headache any extended period of time, pass. There's all these different things that I'm looking at as metrics to say yes to a great deal or no to a marginal deal because I don't want to lose money. I don't want to lose my investors' money. These are deals that I plan on being in for a long time, and you're going to be investing with me. So I want you to get a better understanding of how I make decisions, what I'm looking for, and what me and my team are looking for when we're out there calling owners, looking at properties, walking deals, and making offers. All right. So I know I went through this quickly. If you have questions, make sure, don't get confused on this stuff, guys. This is simple math, but if you're looking to invest and you're looking to invest in a great asset, these are the things that I'm looking for because this is proven for me. I've done this over and over and over again. It's a what is that called? Proven concept, right? This is how I look at deals, how I underwrite, aside from just loving stuff. All right. So I hope that helps you guys today. I thought this was important to make. And if you need anything, reach out to me. If you want to invest with us, go to bell-capital.com. You can hit the button there to schedule a call, book a call with us. Myself or someone on my team will talk to you, find out any questions you have, hopefully get you started with your investment, share deals that we have with you. You got to be accredited to do that for the fund that we currently have open. We're working on deals. We always have active deals. We're making offers on properties, and I want to share those deals with you and show you what we're working on so you can be involved or not. So have a great day today. Like this video, share this video, give it a thumbs up if you loved it, give it a thumbs down if you hate it. Don't be a hater and a hider at the same time. Oh, and like and subscribe to my channel. I want to keep making videos like this for you. I do my best to keep them simple. Sometimes I'm in the studio, sometimes I'm in my Zoom room where I'm at today, but I do this because I want you to see that I'm a real guy. I am an investor just like you. I take money and investment and my investment opportunity is very serious. So if you're going to invest, I want you to have access to me. I want you to see that I'm normal. I don't need to have something glamour and glitz all the time. And if you need that, great. I have that too. But this is just a Saturday where I wanted to share some information. I thought it was important. All right. So make sure to keep in touch with me. Share this video, like it. Let's go. Appreciate you guys. Have a great day today.